Hello and welcome to Business Africa with me, Ronald Kato. This week, Kenya goes to the polls, but with one eye on the economy. A government subsidy has managed to bring down the cost of the country's staple, but for how much longer? The country's dollar reserves are plummeting amid concerns that the incoming government could have to deal with a debt crisis. We'll report on what awaits Kenya's new leaders. Plus, Tanzania reaches a financing deal with the IMF. East Africa's second-largest economy has had to turn to the multilateral lender as budget deficits widen due to the pandemic and volatile energy prices. Also, Nigeria's state-owned oil corporation goes private as Abuja begins a series of tough reforms to achieve efficiency and fight corruption in the oil sector. Stay with us for these and more details. Thank you for joining us. Kenya's vote is just days away, and signs that East Africa's largest economy could be headed for a tough time are ominous. The country's currency, the shilling, has been falling. It means Kenya's Treasury is having trouble paying back its huge dollar-denominated debt. A government subsidy has so far managed to avert a food crisis, except it cannot continue forever. This report from Nairobi.
Kenya's President Uhuru Kenyatta directed the price of 2 kilograms packet of maize flour be lowered to 100 Kenyan shillings, the equivalent of 84 cents, from an average retail price of $1.73, following talks with major millers at the State House. This local miller, however, maintains that it will take more than a presidential directive to lower the price of maize flour. Maize prices increased, and we are currently buying a bag of maize at 6,000 Kenyan shillings, which is $50.60. For us to be in a position to mill a 2 kilograms tin of maize at 84 cents, we have to get a bag of maize at $21. Food vendors reveal that profit margins have dropped since most of their customers cut down on the number of meals they take in a day, while others have stopped buying food. I was used to having 3 meals a day, but I can now afford only 1 meal. I only take lunch and no supper. This comes as the East African nation experiences a rise in cost of living, with presidential frontrunners in the upcoming general election promising to lower food prices if elected. Ken Gichinga, the chief economist at Mentoria Economics, says that the incoming government already has its job cut out, and implementation of its policies will determine if the economy of Kenya will recover or collapse.
If you look at the manifestos, most of these political parties are promising bigger spending, yet you're being told our debt levels are high, and they're not saying how they'll fund it. So I think the government has to be very clear on debt management.
The election's leading contenders have promised jobs and growth without clearly explaining how. If the current conditions are any signal, Kenya's next government should prepare to make tough economic decisions.
Charlie Robertson is the global chief economist at Renaissance Capital. Charlie is also the author of a new book titled The Time-Traveling Economist. Thank you so much, sir, for your time. Kenya's reserves have been falling, dropping to under 4.5 months of import cover. What are we staring at?
We are staring at the risk of a kind of Latin American-style debt default, such as we saw in the 1980s. That's the risk. I've just published this new book, The Time-Traveling Economist, which looks at countries that have gone out and borrowed cash, and they borrow cash because their fertility rates are quite high, and that means their local savings are quite low. And it looks like foreign borrowing is the cheap way to finance investment, to create infrastructure, to create growth. And I totally understand why Kenya's done that in a big way over the last 10 years. And it was fine when global interest rates were dropping, and it was getting cheaper and cheaper to borrow all the time. Unfortunately, because of Western inflation problems, we've now seen Western interest rates shoot up, and as a consequence, everybody's interest rates are shooting up, and suddenly this doesn't look like a viable strategy anymore to borrow so much from abroad.
Speaking of borrowing, Charlie, many times we're concerned with the quantity of debt and not the quality of debt. Has Kenya borrowed for the right reasons? The
borrowing has been largely for infrastructure. Some of the big projects, such as the famous standard gauge railway from Nairobi to Mombasa, that in the long run, it is good. I have no doubt that in the long run, proper transport infrastructure is a very helpful and important investment. But what the book suggests is that you've got to have factories producing exports that earn you dollars. A railway doesn't earn you dollars.
Charlie, debt rose from $16 billion in 2013 to $71 billion in 2021. Should the incoming government prepare for a hard landing?
I think, unfortunately, it has to. So that debt, what's happened with that, as you've borrowed dollars, and the dollars have come into Kenya, many of them have been spent on imports then, so some of them have left, but overall the impact is to keep the Kenyan shilling very strong. And because the Kenyan shilling has been so strong, the debt burden hasn't looked too bad. The Kenyan shilling's strong, so the dollar debt doesn't look too expensive. But when the dollars stop coming in, because no one's prepared to lend anymore, at least not financial markets are not prepared to lend. China didn't want to extend the railway from Nairobi up to Uganda, for example. So you haven't had those new dollars coming in. And as a result now, the Kenyan shilling is starting to weaken. And that dollar debt is now looking more and more expensive relative to the size of the economy. And the way you can break it is to have either a very, very cheap currency so that you run a current account surplus, you're exporting more goods and services than you're importing, or you cut your budget deficit dramatically. Hike taxes, cut spending. But I haven't seen either presidential candidate promise that in these elections.
Interesting. But what then can Kenya's new leaders do to avoid a crash?
Unfortunately, no one, including me or any other economist I'm aware of, expected global inflation and global interest rates to go up like that, like they've done in the last 6 months. And so I think that's just off the agenda. That borrowing option is gone. And so I think right now, the extra growth that Kenya bought for the last 10 years is now going to be paid for with somewhat lower growth. In a good scenario, lower growth. In a bad scenario, debt crisis. But even in a good scenario, I think lower growth for the next few years. There's nothing, I don't think there's much governments can do right now.
Charlie Robertson, nice to have you. Thank you very much for your time.
Pleasure. Nice to talk to you.
Battered by the coronavirus pandemic, which affected tourism and now soaring energy prices, Tanzania's current account deficit has been growing. It is expected to widen to 4% of GDP in 2022. To balance its books, Dar es Salaam has sought over $1 billion from the IMF.
The International Monetary Fund will extend over $1 billion in credit to Tanzania to help the East African country's recovery from the pandemic and effects of the war in Ukraine. The facility, subject to the IMF board approval, will be disbursed over 40 months. Tanzania is the East African community's second largest economy after Kenya. Growth slowed to 4.8% in 2020, recovering to just 4.9% the following year, as COVID-19 travel restrictions battered the tourism sector, a key source of income for Dar es Salaam. The war in Ukraine, too, has caused food and fuel prices to soar. This is the second time in under a year that Dar es Salaam is running to the IMF for assistance. In December of 2021, Tanzania sought over $567 million from the multilateral lender. President Samia Suluhu Hassan has continued with her late predecessor's legacy of investing in big infrastructure, spending billions on railways and modernizing road transport.
Now, for over 50 years, the Nigerian National Petroleum Corporation has worked as both regulator and player in the country's oil sector. But that monopoly has come to an end, with Nigeria opening up the company to private investment.
The Nigerian National Petroleum Company, NNPC, which has existed as a state monopoly for over 50 years, will open up its capital to private investment. It is also in line with a new petroleum bill passed by Parliament last year, which aims to create efficiency in the country's oil sector, beset by a lack of investment and corruption. Abuja hopes that letting the company go private will reduce the government's fiscal responsibilities to do it, thus freeing up fundings for other projects. Last year, the company said it would consider listing on the stock exchange as early as 2024. Analysts say that commercializing NNPC also signals that Africa's biggest economy is preparing to end fuel subsidies, which have been the target of IMF criticism for years. The country will spend $9 billion this year alone on fuel subsidy payments. The subsidies have been criticized for fueling corruption at the NNPC. Nigeria depends on oil for its foreign exchange earnings, but production has been falling over the years due to lack of investment, mismanagement, and bad infrastructure. The country pumped 1.7 million barrels per day in 2021, down from 2 million a year earlier.
And that wraps up this episode of Business Africa. I am Ronald Kato. The news continues on air and online. Bye for now, and I'll see you on the next episode of Business Africa.